If you are listening to this, you likely already sense the instability, the low rumble beneath the facade of market highs. You feel that disconnect between what the media reports and the crushing reality of what your purchasing power buys. But sensing a shift is not enough. Survival in the coming financial tectonic shift requires meticulous preparation, anchored not in hopeful optimism, but in the stark calculus of monetary history. We are not discussing a typical recession, a cyclical downturn from which the central banks can easily engineer a V-shaped recovery. We are discussing the structural collapse of confidence in fiat currency itself, fueled by levels of sovereign debt that have historically led to societal and financial upheaval. I want to take you deep inside the mindset of one of the most successful and contrarian investors of our generation, Eric Sprott. The premise is audacious, yet chillingly logical. How I would get rich, leveraging the most destructive financial event of the decade, the 2026 crash. Forget the easy narrative that stocks always rebound. Forget the complacent belief that the Fed holds enough firepower to prevent the inevitable. The game changed, and the rules of the old economy, where bonds provided safety and the dollar provided stability, are completely obsolete. The reason 2026 is the gravitational center of this impending crisis is twofold: the debt maturity wall and the necessary, yet destructive, policy pivot by the U.S. Federal Reserve. Let's establish the foundational context. We have spent the last 15 years, especially since 2020, attempting to solve a solvency crisis with a liquidity solution. We injected trillions of dollars, pure monetary expansion, essentially modern monetary theory, MMT, practiced under different jargon, to paper over systemic cracks. This wasn't free. The cost is now evident in persistent structural inflation that cannot be tamed by simple rate hikes because the underlying problem is not demand-driven. It is supply chain broken and currency devaluation induced. Currently, the global financial system is addicted to debt, specifically U.S. Treasury debt, which has now ballooned far past $34 trillion. This massive obligation is not static, it requires constant refinancing. A staggering amount of this debt, the short-term paper, matures between late 2025 and 2026. As the interest rates remain elevated, the cost of servicing this colossal debt load threatens to consume the entire discretionary U.S. federal budget. This is the conflict. The U.S. government cannot afford high interest rates, which means the Federal Reserve will eventually be forced to intervene, abandoning its inflation fight. This unavoidable confrontation between fiscal reality and monetary policy sets the stage for the collapse. The financial establishment believes the Fed will cut rates to save the banking system and the housing market. They are correct that the Fed will cut, but they are profoundly wrong about the outcome of that cut. When the Fed pivots aggressively in 2025, forced by an economic contraction that threatens political stability, the market will not see it as a sign of stabilization. It will see it for what it truly is, a desperate signal that the central bank has surrendered to fiscal dominance. It will signal the definitive end of the dollar as a credible store of value. So, where does capital hide when the global reserve currency enters its final parabolic devaluation phase? This is the open loop we must resolve. If your savings are in dollars or dollar-denominated assets like corporate bonds and conventional ETFs, you are simply holding sophisticated IOU slips, written in a currency headed toward terminal sickness. We need a strategy that thrives not just when the nominal value of stocks falls, but when the underlying unit of account, the dollar itself, is rapidly being incinerated. We need an asset class that is outside the counterparty risk of the banking system and cannot be printed into oblivion by desperate central bankers. The development of this strategy pivots entirely on understanding the mechanics of financial destruction. When the dollar loses confidence, its nominal value against real assets will skyrocket. This is where the true wealth transfer occurs. Let's dissect the mechanism of the inevitable pivot. Right now, the Fed maintains a tough stance on inflation, keeping the Fed funds rate elevated. This high-rate environment is simultaneously bankrupting the U.S. government via interest payments and creating mass insolvency in the commercial real estate sector and among smaller banks holding long-dated low-yield assets. Powell's dilemma is agonizing. Maintain high rates and guarantee a deep, painful deflationary depression, a political non-starter, or pivot/rates, implement aggressive quantitative easing, QE, again, and trigger a currency crisis. Sprott's analysis dictates that the choice is clear. Central bankers, being political animals ultimately concerned with maintaining the illusion of stability in the short term, will always choose inflation over deflation. They will sacrifice the currency to save the debt structure. This means the 2026 crash will not look like 2008, where liquidity dried up and nominal prices plummeted. Instead, it will look like the 1970s, but magnified by global interconnectedness and $34 trillion of debt. A period of stagflation giving way to hyper-monetary inflation where the price of everything denominated in dollars goes vertical, even as economic activity stalls. This is the pattern interrupt that most conventional investors miss. They are preparing for a stock market crash. We are preparing for a currency funeral. Now let's talk specifically about the assets that fail in this environment. Bonds, the supposed safe haven, will be utterly destroyed. Fixed income is a guarantee of real capital loss when inflation is running persistently high. If you buy a bond that yields 5% and inflation is structurally 8 or 10%, you are guaranteed a negative real return. This realization will trigger the great bond market exodus, a cascade of selling that forces the Fed to become the buyer of last resort for U.S. Treasuries, fully monetizing the debt. This act is the explicit trigger for the dollar's final decline. So if fiat currency fails and fixed income is destroyed, what remains? Only real assets. And among real assets, land, commodities, energy, nothing offers the unique combination of liquidity, historical reliability, and non-counterparty risk protection quite like precious metals, specifically gold and silver. Eric Sprott's core conviction, the foundation of this generational wealth strategy, rests on a profound structural imbalance between the paper trading of these metals and the physical reality. Over decades, the supply of above-ground, readily available physical gold and silver has become terrifyingly tight relative to the enormous paper derivatives market, manipulated lower by central bank interventions and commercial bank shorting. The physical market is screaming scarcity, while the paper price has been artificially suppressed. The 2026 crash will be the moment this suppression finally snaps, driven by massive sovereign and institutional demand seeking shelter from the collapsing dollar. When central banks and sovereign wealth funds panic, and they will, they do not buy futures contracts. They demand physical metal. This brings us to the critical shift in Sprott's proposed portfolio architecture, the silver-gold ratio. This is perhaps the single most important lever for multiplying wealth during the currency crisis. Historically, the geological ratio of silver to gold in the Earth's crust is approximately 10-to-1 or 15-to-1. The historical monetary ratio, reflecting usage and rarity, has often hovered around 16-to-1 during periods of true monetary stability. For the past 20 years, thanks largely to financial engineering and neglect of silver's monetary role, the ratio has often resided between 70-to-1 and 90-to-1. This is a profound historical anomaly. Silver, an industrial metal with increasingly constrained supply, is trading incredibly cheaply relative to gold. Gold is the monetary metal of central banks, the foundation of stability. Silver is the monetary metal of the people, exhibiting far higher volatility and greater potential leverage during a monetary crisis. Therefore, the initial setup for this strategy, as we transition into the 2026 reckoning, is predicated on the violent normalization of this ratio. We are talking about a scenario where the ratio potentially collapses from 80-to-1 down toward 30-to-1, or even lower, reflecting historical norms and industrial necessity. If gold doubles, silver has the potential to triple or quadruple, delivering geometric gains simply through relative value alignment. Remember, we aren't talking about weathering the storm. We are talking about using the storm to achieve generational wealth, exactly as Sprott has planned for decades. The strategy is built on realizing that when the monetary system disintegrates, the demand for anything tangible will explode, and the cheapest, most leveraged, tangible monetary asset will provide the greatest returns. That asset is physical silver. The great revelation in this methodology is understanding how to achieve maximum leverage without utilizing dangerous margin or complex option strategies. The collapse itself provides the leverage. First, we establish the foundation. A strong allocation to physical bullion, both gold and silver, held outside the banking system. This is your insurance policy, your absolute hedge against financial nihilism. However, merely holding bullion yields returns equal only to the rise in the metal's price. To get rich, you need the multiplier effect. The multiplier is found in the junior mining sector. The transition of capital must be perfectly timed. When the currency crisis hits, gold and silver prices will soar rapidly, often referred to as the first phase rise. This initial surge provides immediate, necessary liquidity to the long-depressed junior mining, exploration, and development companies. These small companies, holding massive in-ground resources that were economically unviable at $1,000 gold or $20 silver, suddenly become exponentially valuable. Imagine a junior miner with a marginal cost of production of $1,500 per ounce of gold. When gold trades at $1,800, their profit margins are slim. But if the monetary crisis pushes gold to $4,000 or $5,000 an ounce, a number entirely consistent with hyper-monetary inflation, that marginal producer's profit margin expands by several 100%. Their stock price, which often languishes near zero due to financing difficulties, explodes. The leverage inherent in a mining stock over the commodity price is typically 3-to-1 or 5-to-1. A 100% move in gold can translate to a 300 to 500% move in the associated equity. The climax of this introductory phase is the recognition that the Sprott strategy is fundamentally about leveraging two major crises simultaneously: the monetary collapse and the market inefficiency surrounding undervalued mining assets. The initial trade is to position aggressively in physical metal to capture the initial monetary flight, and then, using that rising capital base, pivot into the highest quality, lowest risk, yet most deeply discounted junior and intermediate miners, maximizing the leverage just as the metal prices enter their parabolic phase in 2026. This is the moment the foundational hedge transitions into a speculative generational trade. We have now established the undeniable macroeconomic timeline. The 2026 debt wall forces the Fed pivot, which initiates the dollar's terminal decline. We have identified the only viable asset class, precious metals, and we have outlined the strategic shift from bullion safety to equity leverage, specifically targeting the disproportionately cheap silver market to achieve superior returns. The focus must be precise, identifying the companies poised to maximize this explosive shift. Understanding the why is essential, but execution requires meticulous selection. Now that the stage is set, the tension is built, and the timeline is clear, we must move to the critical specifics. We need to detail the exact portfolio ratios and name the specific companies, the hidden gems in the junior space, that possess the high-grade resources and strong management teams necessary to turn a survival strategy into extraordinary wealth. The second part of this discussion will detail the specific entry points, the exact allocation percentages between gold, silver, and their associated equities, and the crucial checklist Eric Sprott uses to select those high multiplier mining stocks that will ensure generational wealth when the financial system hits rock bottom. Tune in for part 2, where we break down the exact ratios, the specific investment vehicles, and the companies that multiply this survival strategy into profound, lasting wealth. You do not want to be holding paper when the great monetary reset of 2026 finally arrives. If you followed the initial argument, you understand that the 2026 timeline is not arbitrary. It's the convergence point of unprecedented national debt rollover requirements, the political impossibility of austerity in a major election cycle, and the final, fatalistic reliance on modern monetary theory, that desperate, childish belief that if you need more money, you simply print it faster. We established the structural rot. Now we must discuss the construction of the lifeboat, not just for survival, but for the multiplication of wealth that only occurs during systemic financial resets. To truly get rich in this environment, you cannot think conventionally. The typical hedges, T-bills, real estate, even broad market ETFs, will fail you. T-bills provide a negative real yield, guaranteed to erode purchasing power as the Fed frantically tries to keep rates suppressed to service its own debt. Real estate, while tangible, suffers massive illiquidity and often crippling taxation when local governments inevitably try to plug their deficits. We are looking for something portable, universally recognized, non-dilutable, and, crucially, completely outside the fractional reserve banking system. This leads us inescapably to the monetary metals, gold and silver. But simply owning physical metal is only half the trade. It's the preservation trade. The true wealth accumulation trade, the one that generates the 20-fold returns that fundamentally alter your financial trajectory, lies in understanding the immense, undervalued leverage embedded within the junior and intermediate mining complex. Let's contextualize the scale of this opportunity. When central banks are forced to abandon any pretense of fiscal responsibility, and they will be faced with a choice between national bankruptcy and hyperinflation, the money supply, already bloated far beyond the production of actual goods and services, will explode. The price of gold, historically and mathematically, is nothing more than the reciprocal of currency confidence. As confidence approaches zero, the nominal price of gold must approach infinity. My strategy centers on asymmetric risk. I am risking a measurable amount of capital on a trade where the downside is limited, the cost of production plus overhead, and the upside is potentially limitless, driven by a global monetary panic that has no historical parallel in terms of sheer leverage and debt load. We start with silver. Silver is the ultimate sleeping giant, the metal that offers unparalleled torque when the monetary gears start grinding. Everyone focuses on gold's role as the primary reserve asset, but gold is already significantly priced into the existing fear matrix. Silver, currently trading at a historically ridiculous ratio to gold, often hovering around 80 or 90 to 1, is simultaneously a monetary metal and an indispensable industrial metal, consumed in solar panels, electric vehicles, and high-tech electronics. The key insight is this. The above-ground accessible inventory of investment-grade silver is dwindling rapidly, far more so than gold. Industry consumes vast quantities every year, much of which is never recycled. This consumption creates an ongoing deficit, drawing down strategic stockpiles. When the crash hits, the initial demand will be monetary. People fleeing depreciating dollars will pour into physical metal, driving the price up. But unlike gold, silver hits a point where industrial demand, which is inelastic and requires millions of ounces just to keep manufacturing lines running, collides with investment panic. This collision is what generates the parabolic move. If the gold-to-silver ratio merely reverted to its long-term mean, say 15 to 1, and gold was trading at my conservative target of $5,000, silver would be $333 an ounce. This is not speculation. It is mathematical reversion based on thousands of years of human valuation history, applied to a hyper-leveraged supply and demand squeeze. Now, how do we turn a triple into a 20-bagger? The answer lies in the miners. Physical metal is insurance. Shares in the best mining companies are the accelerator pedal. Here is the mechanism. A miner has a fixed cost of production, known as the all-in sustaining cost, AISC. Let's imagine a highly efficient gold miner with an AISC of $1,200 per ounce. If gold is trading at $1,500, the miner earns a profit of $300 per ounce. That profit is leveraged, but the leverage is marginal. But what happens when the price of gold, driven by the flight from fiat, suddenly jumps from $1,500 to $5,000? The miner's cost base of $1,200 remains relatively fixed in the short to medium term. Their profit margin expands from $300 to $3,800 per ounce. Their profit margin has increased by more than 1,200%, while the price of the underlying commodity only increased by 233%. This explosive expansion in profitability translates directly into exponentially higher share prices. The market discounts the future cash flows of these companies, and when the market realizes these cash flows are accelerating vertically, the stock price doesn't just double or triple. It can multiply by factors of 10, 15, or 20, far outpacing the underlying commodity move. This is the trade. This is the asymmetric opportunity that only presents itself during these terminal phases of a monetary system. My selection criteria for these miners are rigid and unforgiving. I am looking for quality, not just exposure. First, jurisdictional safety. We must avoid geopolitical risk. When capital flows desperately seek safety, they avoid countries with unstable governments, high royalty risks, or nationalization history. I focus predominantly on North America, Australia, and certain highly stable Western jurisdictions. Second, high grade and low AISC. The lower the AISC, the higher the leverage to the commodity price. We want companies that can weather any temporary market volatility while still minting money when the price ascends. High grade means fewer tons of rock moved, lower energy costs, and thus lower AISC. Third, reserve growth and longevity. The company must have a clear path to expanding its reserves, ideally through the drill bit on existing properties, rather than relying on expensive acquisitions. I favor companies with demonstrated expertise in exploration and long mine lives, ensuring the cash flows generated by the high commodity prices are sustainable over a decade or more. Fourth, minimal debt. Debt is poison in a tightening credit environment, and even more so when the systemic crash freezes capital markets. A strong balance sheet, preferably with net cash positions, provides the resilience needed to navigate the turbulence and, crucially, allows them to be opportunistic acquirers of weaker, debt-laden competitors during the crisis. This strategy is particularly effective in the silver sector, which is chronically starved for capital. Many fantastic silver projects have been delayed or undervalued because generalist investors view silver as too volatile or too complicated. When the institutional money finally wakes up, when the pension funds and sovereign wealth funds realize they are trapped in depreciating treasuries, they will flood into this small, illiquid sector, driving valuations to heights that seem unimaginable today. The key to the 2026 crash trade is understanding that we are now past the point of monetary policy adjustments. We have moved into the realm of fiscal desperation. When the crisis hits, the Fed's only remaining tool will be direct monetization of deficits, massive quantitative easing, possibly coupled with yield curve control to pin long-term rates near zero, effectively nationalizing the bond market. This is the great trigger. As the world watches these desperate measures being deployed, the final illusion of dollar strength will shatter. Global institutional holders of U.S. debt, foreign governments, pension funds, insurance companies, will begin the accelerated, irreversible shift out of paper assets and into hard assets. This capital flight will not be slow. It will be sudden, aggressive, and overwhelming, because nobody wants to be the last one holding the depreciating liability. Let's address the climax, the target valuations. If we conservatively estimate that the money multiplier, M2, needs to be backed by gold to restore confidence, the math is horrifying for the dollar holders. Currently, the official U.S. gold reserves are approximately 8,133 metric tons. The M2 money supply is north of $21 trillion. If we were to apply a conservative gold backing ratio, say even 20%, the resulting gold price is not $3,000 or $5,000. It is north of $20,000 an ounce. My target of $5,000 is predicated on the initial panic and institutional recognition of deep undervaluation, driven by the first wave of capital fleeing fiat. The full reset potential is far, far higher. But we are focused on the executable trade for 2026. $5,000 gold and $200 silver are achievable milestones in the immediate aftermath of the crash, driven by the sudden realization of systemic risk exposure. When you hold a basket of high-quality zero-debt miners, those price moves translate into a 15 to 20-fold return on capital. You transition from merely surviving the destruction of paper wealth to accumulating generational wealth, entirely insulated from the wreckage. This is the ultimate payoff of the Sprott method, not predicting the future perfectly, but positioning ourselves for the inevitable consequences of reckless financial policy. The system is designed to reward the borrower and punish the saver, but in the final act, when debt becomes mathematically insurmountable, the system collapses inward, wiping out leveraged creditors and creating generational fortunes for those holding assets that cannot be printed or defaulted upon. The question I am most often asked is, when do I sell? The exit strategy is almost as important as the entry. You do not sell merely because the price has tripled or quintupled. That is short-term thinking. You sell when the fundamental conditions that necessitate the trade have been resolved. You sell when central banks have been forced to structurally reform the monetary system, perhaps through a massive revaluation or the explicit introduction of a new asset-backed digital currency, signaling a return to fiscal discipline. You sell when the gold and silver markets are flooded with institutional supply, and when every mainstream financial commentator is declaring the death of the dollar crisis and the new era of stability. But until that moment, until you see genuine, painful, politically unpopular fiscal austerity, coupled with a fundamental, structural change in how money is created, you hold your minors. You maintain your core physical position. You continue to insulate your wealth because the massive returns are harvested in the final, euphoric blow-off top, which always follows the deepest monetary panics. The crash initiates the panic, and the panic ignites the wealth explosion. We are not merely observing history. We are preparing for the culmination of 3 decades of financial malpractice. The crash of 2026 will not be a minor correction. It will be a systemic reset, driven by a complete loss of faith in debt-based currency. The time for deliberation is over. The time for tactical, focused, highly leveraged action is now. The window to accumulate high-quality assets in this sector before the institutional tidal wave hits is closing fast. Every ounce of gold or silver, every share in a debt-free, high-grade miner that you acquire today is a proactive step toward protecting and multiplying your financial future in the chaotic years ahead. Do not wait for the headlines to confirm the disaster. By then, the asymmetric returns will already be locked away by those who had the foresight to read the structural insolvency of the fiat system. The great wealth transfer always occurs before the public panic sets in. The choice is stark. Be the one who transfers the wealth or the one who receives it. Identify those premier producers, allocate your capital defensively and aggressively, and prepare for the kind of market event that happens once in a lifetime.